Good afternoon, everybody. Welcome back to the second chapter today. Today we'll be looking at financial statements, taxes, and cash flow statement. And so what do we mean by that? Cash flow, which means the source of cash and how do we use cash. That's what today will be. So in essence, what will be the concept? So concept will look at understand the difference between accounting value and also book value. Or when we say accounting value, it means the same thing as book value. And the market value. We'll find a difference between accounting income and cash flow. And also know how to determine cash flows from its financial statements. And understand the difference between the average and marginal tax rates. Finally, we'll look at understanding the basic of capital cost allowance, which is CCA, and also looking at what we call undepreciated capital cost, UCC. And so find the difference between what is CCA and what is undepreciated capital cost. We do some calculation on how these are calculated and why we have it. So in a nutshell, the chapter outline will look at talking about the financial statement. Financial statement, we're looking at the statement of financial position, which I'll show you in a minute what it means. We also look at statement of comprehensive income, cash flow statement, look at the taxes, how do we calculate capital cost allowance, and so basically that's what the chapter will look like today. So in a nutshell, let's get started. What are these financial statements? We start with the statement of financial position. Statement of financial position typically means it's a snapshot of the firm's assets and liabilities and the equity at a given time period. So in essence, the reason why it's called statement of financial position is looking at a statement of what a company is or worth as of right now, as of today. Hence, when we prepare the statement, we say as at the year end or as at the date that the statement was prepared. So what are some of the elements or some of the content of this statement? One of it will be we have the assets which are listed in the order of liquidity. And when we say liquidity, it simply means the ease with which this element, this asset can be converted into cash equally without significantly changing or losing its value. That's why the meaning of liquidity. Equally, the statement therefore will identify three main elements. The first being the assets, which are the items the company owns, which they use to generate revenue for an organization, for the company. Equally, we have the liabilities. Liabilities are debts or obligations that company owes, which they have to pay to whoever lent the money to them. And so liabilities. And the third part would be the stockholders' equity. And stockholders' equity is simply a claim of the owner in the business. So it's really the residual between the company total assets and the liability, which is used to define the equity, which is the stockholders' equity. So in essence, what does it look like? This statement of financial position, it looks like this. So on one hand, we have to your left side, we have the total assets, which is also divided into three main parts. So the first being the current assets. The current assets are the items that a company uses on the daily basis. Okay, it includes something like cash of the company, the accounts receivable, the inventory. Okay, so all these combined together will be used in the day-to-day to run the operation of an organization. Below that, we have some what we call non-current assets, which is what we call fixed assets, equally divided into two. The first being the tangible fixed being Example would be building, machinery, vehicles that company use on a daily basis to generate this revenue. And as such, we say tangible in the sense that you can see, touch, feel, and use. Whereas the second part of fixed assets is called the intangible. They are called intangible because of their substance, which means they are not able, you can't see them, okay? It's not something which you can see or touch, but it's an asset. Example would be a logo, for example, trademarks. These are unique features a company will use to identify themselves, and equally, it makes, for marketing effort, for example, they use that to communicate to the world. It's a unique identity in the sense that that is what differentiates them from the competition. And so trademarks will be one, logo. We also have other forms which are like patent, for example, or rights, the example of intangible fixed assets. So that's on the asset side. When we flip to the side, we have the liability, which equally we divide it into two. The first being current liability. The current liabilities are the short-term obligations which falls due within a year. Example would be accounts payable. Accounts payable will be as a result of company purchasing their inventory on a credit basis, and that's an example. We also have shorter other ones like a salary payable, if they owe salary to employees at the end of the year. So these are examples. We also have like note payable at a short-term amount, okay, falling due within 1 year. The second part of the liability that we talked about is the long-term. Long-term, these are items falling due after more than 1 year. Example would be bond, for example. Okay, it's a long-term debt company has to run its business. We also have note payable, for example. It's typically long-term. Now, the third part of the statement of financial position is the stockholders' equity. Equity is the claim of the owners in the business. Between the current asset and the current liability, we have something called net working capital. So which means the difference between the current asset, which are the items used within 1 year, and the liabilities, which are the obligations falling due within 1 year. The more the current assets bigger than that of the current liability, the better. So the more, which shows that the company has enough liquidity or having enough working capital to run their business. And again, this is also what equally defines if company is actually will be able to continue in operational existence for a foreseeable future, which we use one accounting terminology called the going concern. So the higher the number of working capital, the better for the company. That means they're able to generate enough cash, enough liquid cash to run the affairs of the company. Just to explain a little bit further, so here we are. So net working capital, therefore, will simply be a difference between the current asset and the current liability. So which means the positive cash, received over a period of time for over 12 months exceed that of the cash paid out, which means if the higher they have that amount, that residual value of net working capital, the better the health of the firm. So in essence, liquidity means being able to convert cash quickly without a significant loss in the value of the item. Equally, liquidity firms are less likely to experience any financial distress because they're able to have enough funds to run the affairs of the organization. However, liquidity assets earn lower return because this amount is stocked within the organization and not being effectively and efficiently used to generate more revenue, so no return. However, we have a trade between liquid and liquid assets. So in essence, a balance of the two will typically enhance efficient operation of organization. So basically, that's liquidity. Now, to go in there to now look at what this system of financial position looks like, we have this. The system of financial position, as I said, in this example, Canadian Enterprises, we have two comparable or comparative figures, dates, which is 2014, 2005. So 2014 is the opening balance and 2015 is the closing balance. We have them side by side, and in that way we can compare companies' activities and also performance over the periods. So on the left-hand side, we have the current asset, cash, and also we have account receivable, inventory. We have its total current asset for 2014, 2015. We have the fixed assets, equally net fixed asset here. And the reason why we have net fixed assets is because we've taken into consideration depreciation. So depreciation is taken from the respective costs to arrive at the net fixed assets. On the other hand, we have the current the liabilities in an owner's equity. So first we talk about the current liabilities, which includes the accounts payable for those two periods, and we have the note payable for those periods, adding the two give us the total current liabilities for 2014, 2015, respectively. And then we have the long-term debt, for both periods, 2014, 2015, and then at the bottom of the long-term debt, we have the owner's equity, which comprise two areas or two elements. We have the common stocks, which are the main common equity form, company uses to finance company's operation. And then the second part of the equity is the retained earnings, for the respective periods. So basically, this is a snapshot of an organization for over the two periods at which we reported. Equally, we'd like to talk about the value versus the costs. Now, in this type of financial position, part of what we understand is to provide book value of an asset, liabilities, and equity. Why do we say book value? Book value simply means the original cost less any depreciable amount, at the net book value. Okay. Here we also need to look at the market value, which is the price at which the assets and liabilities can actually be bought or sold in any particular period. And also, one of the questions is market value and book value, usually very different. Why? Because of the historical nature. We're looking at when we purchased the asset several years back, and then what's the value today? So which makes the difference. But in essence, according to the accounting principle, we're not allowed to use current market value, but rather all items or all accounts written should be represented in its historical costs. So hence we use the historical cost convention. So which is why it's important, to make making decision process. So again, in making decision here, we'll look at the opportunity costs that we derive from that asset. And again, in making decision, we want to look at if there'll be an incremental cost. So it's really the incremental cost which is relevant, not a sunk cost, which means a cost which already been incurred will not make any difference in terms of decision making, but any incremental will make that difference. So it's very important when making a decision. So going back to the International Financial Reporting Standard, therefore, allows companies to use a historical cost method, as I've explained earlier. Also allows you to revaluation or fair value method. So which means all items in an asset class should be revalued simultaneously and equally. Revaluation should also be performed with enough regularity to ensure that carrying amount is not materially different from the fair value. And when we say carrying amount, it simply means the book value. That's the new terminology under the International Financial Reporting Standards. So in a nutshell, that is the statement of financial position. So the next statement is the statement of comprehensive income. With this statement, it's more like a video of an organization operation for a specified period. And generally, it reports the revenue as the first, and also expenditure. So, which means this statement reports the revenue company generates in its original, in the regular normal operation. Okay, and then we subtract the expenditure which were incurred in generating this revenue. Again, with the IFR rule, identify matching principle. So what does that mean? Matching principle means we're matching expenses with the revenue that it generates in the period. So in essence, IFRS say we should show revenue when it accrues, and also match it with the expenses required to generate that revenue. And so when we talk about revenue here, we're not looking at when actual cash is paid. We're also looking at when the performance has been performed. So there's performance. So in essence, when we talk about sales, i.e., when it comes to goods, when the sale is made, not when, again, when goods are delivered, define when revenue is earned, not in particular when actually cash is received from the sale of goods. If it has to do with services, it means when the service has actually been performed, completed, and that's when revenue will be recognized. On the other hand, when we talk about the expenses, expense here relates to the activities which has to be performed in order to generate this revenue. And as such, it's not when we actually make the payment for the expenses, but rather when we enjoy or incur the expense. Such an expense will be light and heating, salaries, office stationery expenses. So all these are expenses which are incurred in order to generate the revenue. And so what does it look like? Here we are. So we have the statement of comprehensive income, which look at first and foremost net sales. And when we say net sales, simply what we're saying is we're subtracting any maybe discount and stuff like that. That's what we have net sales. So net sales, we subtract the cost of goods sold. Cost of goods sold means the goods that we sold, the cost to the company. Okay, so which means the landing cost to the company. And when we talk about cost of those goods simply mean the total cost incurred in order to bring the goods to its location condition for the purpose of resale. And that's the definition of, and that we call cost of goods sold. On top of that, we subtract the depreciation. Depreciation here is the loss in value of an asset due to use to generate the revenue. That is the depreciation. So when we add the two, so the cost of goods sold and the depreciation, subtract that from the net sales, we have something called earnings before interest and tax, EBIT. So in this case, we have sales of 1,509, and then we have cost of goods sold of 750, depreciation 65. The subtraction, we get earnings before interest and tax of 694. And then, of course, we have interest paid of $70, and then which brought us to income before tax of 624. And then we have taxes, 250. At the end, we have our net income of $374, out of which 65 is paid to our dividend, as dividend to our shareholders, and the difference between the 65 from the 374 net income earned in the period gave us an addition to retained earnings of $309,000, which will be added to the equity carry forward, which is reported in the balance sheet, statement of financial position, which we looked at earlier. Now, when we look at sales, cost of goods sold, and depreciation, just before we get to the earnings before interest and tax, we call that operating activities. Hence, the reason why we did not include the interest paid as part of the expenditure, which before, and so we have to look at the interest paid as a non-operating activity. Reason being that typically interest paid are not really an operating activity, and so we have to separate it from. And again, one of the reasons why we said that is because interest paid are not really to generate revenue, but rather is the cost of borrowing, to run the company. So basically, that's why we treat it as a separate item, line item. Okay, so that's the statement of comprehensive income. Now, moving forward, we now also look at the statement of cash flows. Statement of cash flows is also most important piece of information that the financial manager can also derive from the financial statement. We look at how cash are generated from utilizing assets, and also how it's paid to those that finance the purchase of the assets. And there are different elements within the cash flow statement which we'll look at. Again, the full statement of statement of cash flow will be looked at in the next chapter 3. But momentarily, we'll look at some element of the cash flow statement. One of it is called the cash flow from the asset. Again, here when we talk about cash flow from asset, we're looking at cash flow to the bondholders and cash flow to the shareholder. The two of them make up the cash flow from assets. And the second part would be cash flow from assets. And so this is the operating cash flow minus the net capital spending and minus the changes in net working capital. Other ones we have will be using the example of Canadian enterprises. We're able to calculate the following. The first being the operating cash flow. Operating cash flow, which is derived from the income statement. The IS means income statement. From the previous slides, we have the earnings before interest and tax, which we add division back. And the reason why we add in division back is because depreciation is a non-cash item. So in essence, it does not involve physical payment of cash. And so we add it back. So in order for us to calculate the operating cash flow, we look at the total earnings before interest and tax, add back depreciation, but tax is a cash item, which is actually a cash expense paid to CRA. We subtract that. If we do that, we'll get $509 as the operating cash flow incurred in the period. And then we have the net capital spending. The net capital spending, this is, again, it's looking at the balance sheet item and the income statement item. So here we're looking at the ending net fixed assets and then next fixed. So in this case would be 2015 figure minus the beginning, which is 2014 figure, net fixed asset. But we add back depreciation in the period, and the difference in terms of net capital spending, it's 130. Moving forward, we have changes in net working capital, which is the balance sheet item purely. Here we're looking at the ending net working capital. And by the way, net working capital is simply the current asset minus current liability. Okay, so we have that. So we do the same thing we do it for 2015, which is the ending balance, and we do for 2014, which is the beginning. And so the difference between the two gives us that change of $330 for the period. We also have the cash flow from assets. All right, so cash flow from assets will be $550, which we got for operating cash flow, minus the net capital spending and minus the changes in net working capital. And that gives us the total cash flow from assets. And also, just to do more reconciliation, we have cash flow from to creditors equally a balance sheet item, and also income statement, which is the interest paid minus the net new borrowing. So if, for example, we'll find a difference between what was the balance, credit balance, also long-term debt last year compared with the long-term debt for this year. And so we find a difference, and that's how we got the $24 right there. And so we also look at the cash flow to stakeholders, which in terms of dividend paid. So dividend paid net new equity raised. In this case, we have 25. So if we add the two together, the 24 and 25 simply add to the 49, which is the reconciliation. So hence, the cash flow from assets equals the cash flow to creditors and the cash flow to stockholders. The two of them make up the cash flow from assets. So notice that cash flow, identity holds for that calculation. Other areas which we also look at would be looking at current assets. These are examples that we can also use to do more calculations. So we have current asset in 2011 and 2012, current asset, and then we have current liabilities for respective period, fixed assets. And then we can, this is an example where you can also do your activities, which I'm going to post. Now, the tax we'll be talking about for this class finance, we're not looking at how CRA does the calculation of income or personal income taxes, but what is really important here for the purpose of our class is to look at the areas of capital cost allowance, which we call the CCA. And as such, what we're looking at, so we're not looking at individual taxes, rather we're looking at the corporation taxes. So corporation tax is what will be relevant for our class. So marginal rate, therefore, is the percentage paid for the next dollar earned, on an income, whereas the average is the percentage of that income that goes to pay to taxes, such as the tax bill and taxable income. So tax on investment, therefore, this is when an investor holds stock, for example, they buy, they are subject to two types of taxes, really. The first being the dividend tax credit. So here we look at the tax formula that reduces the effective tax rate on dividend. And again, individual, they are taxed on an income tax regime, whereas the corporation, they're taxed on the corporation tax regime. Another area which also need to look at is the fact that if an investment is held for the gain and increase in value of those investments as such, there's something called capital gains tax. With capital gains tax, it means the increase in value over the purchase price, and as such, is taxed half, so 50% of the amount of gain earned is what is taxed at the respective marginal tax rate of that individual. So as I said earlier, what is important for our class is really the capital cost allowance, which replaces the depreciation. So having said that, CCA, which is called capital cost allowance, is depreciation for tax purposes. And the reason why we talking about CCA as opposed to depreciation is the fact that depreciation has a lot of problems. Why? The reason is that they are subject to estimates. We have three different forms of calculating depreciation. For example, we have straight line method, so which means look at the total cost of the asset, which have divided by the value or the the useful life of the asset, and that gives us an amount which we use as an expenditure, depreciation expenditure for the period. If we don't use that, we can do double declining. We still look at, or we can look at the units of production. All these are all estimates, and because of that, you also produce different results when calculating the statement of comprehensive income. And again, it depends on how company try to hide this revenue. And as such, to avoid all these estimates, CRA come up with this rule, which is to do capital cost allowance, which we'll be looking at some of the class in a few minutes. So CCA is then deducted before taxes and act as the tax shield. Tax shield meaning shielding an income from taxation. That's what it is. So every capital asset is now assigned a specific asset class by the government, which is not universal. And every asset class is also given a depreciation method and rate. And also, for regardless of the period when those assets are acquired, the half-year rule applies. So which means the first year of acquisition, only half of the asset can be used for CCA purposes. So in terms of claiming the allowance, the half of whatever. So for example, if you have 100,000 in asset, only half of that, which means 50,000, will be applicable for current cost allowance. So what are some of these class of assets we have? We have class 1, which is at the rate of 4%. And the definition of this is the asset, which are buildings which were acquired after 1987. That's class 1. Class 8 is at the rate of 20%, and that includes furniture and photocopier or office equipment. And we have class 10, which is also 30%, and that includes the van, trucks, tractors, and equipment for an organization. Class 13 is straight line method, and that includes assets such as the leasehold improvements. So say, for example, you just rented an open space, and all the partitioning and everything you put in to make the place ready for intended purpose will be subject to, will be an example of a leasehold improvement, and that is subject to a straight line, so over the useful life. We have class 16, which is at 40%. Again, this includes taxi cabs and rental vehicles. And then lastly, we have class 43, which is at the rate of 30%, and this includes manufacturing equipment. Now, here's an example on how to calculate current cost allowance. So here we are. We have this example. ABC Corporation purchased 100,000 worth of photocopier in 2015. Photocopier fall under asset class 8 with a capital cost allowance rate at 20%. Now, question is, how much CCA will be claimed in 2014 and 2016? Just a heads up, we remember that we're going to do 50%. We say half-year rule applies. So 50% of the 100,000 will give us the 50,000, which is the beginning fixed assets. And then it's class 8. And so we have, which is at 20%. So here we are. We got 20% of the 50, and the current cost allowance for that period is 10,000. And as such, to find the undepreciated capital cost allowance, which you call UCC ending, which is the ending fixed asset, we have 40. So meaning we took the current cost allowance for the period minus the beginning current cost allowance. And that gave us 40,000 based on the half-year rule. However, going to the second year, the other half that we have not depreciated will be added to the 40,000. Hence, that's how we got to 90,000 in 2016, and we continue thereon. So for 2016, it's going to be 100% of everything. So which means less the 10,000 originally. So in essence, this is a reducing balance method. Okay, if you look at the full value was 100,000, and then we took away 10,000 first year, the reducing balance is 90,000, which we got by adding the 40,000 remaining plus the half of the 50,000 that gave us the 90,000. And then we continue and then add that 20%, gave us 18,000 in 2016, and then 18 minus this 90, which was the beginning UCC, and that gave us the ending UCC of 72,000. UCC means undepreciated capital cost or ending fixed asset, means same thing. Additional concept is this. Usually, firms have multiple machines. In other words, more than one photocopier in an asset class, so we have to do them separately. Each one of them will be looked at separately. And also, when asset is sold, the asset class is also reduced by realized value, of the asset or by its original cost, whichever is lower, is what we apply. And as such, closing an asset class means when asset is with the last asset in an asset class is sold, then the asset class is terminated. This can result in what we call either a terminal loss or a recapture. Okay. So just to show a little bit, so when we talk about, we can have two situations, terminal loss or we can have recapture. When we talk about terminal loss, it simply means a situation whereby the ending UCC is greater than the cost of disposal. So i.e., we're looking at the price paid to dispose of the particular asset. So here we say ending UCC, ending UCC is greater than disposal amount. Okay, so in essence, it gives a kind of a loss. There's with this loss, it means the company will not incur any tax liability. That's the implication. On the other hand, when we talk about recapture, this is a situation whereby the ending UCC is less than the disposal amount. So which means company realized more than the value of the asset at the end of its useful life. So this amount, this is the scenario, will give rise to a tax liability. So company will have to pay taxes, of course, after deducting all the applicable tax credits. So that's different between the terminal loss and the recapture. So here's another example. We're looking at Cool Drinks Corporation that purchased 300,000 worth of bottling machinery in 2013. Machinery falls under asset class 43 with a current cost allowance rate of 30%. So in 2015, Cool Drinks sold their machinery for $150,000 and moved their production to Mexico. Here we need to determine if there was a capital gain or a capital cost allowance recapture or a terminal loss. And also if the machine if the machine was sold for $120,000. So with this scenario, this is the solution. So it is a solution. So in the first year, because the half-year rule applies, capital cost originally was 300,000. So half-year rule applies. 50% of that would be 150,000. Because of class 43, the capital cost allowance in that period, 2013, came to 45,000. And so the ending, so subtracting 45 from 150 gave us 105. But we need to add back the 150, which was the half-year rule, which which was not applicable the first year, and that gave us 255 in the second year, and then we continue. And so at the end of the day, we have for 2014 we have some 6,000, which was the capital cost allowance, and we have ending UCC, which was 178,500. Again, we carried that forward to 2015, and so we also depreciated at 20%, and we got 53,550, and then ending UCC was 124,950. Now, based on this, now we're told that at 150 we have a recapture. So we sold the asset for 150, whereas the asset cost, the ending UCC was 104,950. So which means we have a recapture of 25,050. So which means with that situation, we have a tax liability, which will be payable on the gain of 25,050. However, if we had sold the asset for lesser value, say 120 for example, which means it will have been lower than the ending capital cost, on depreciated capital cost allowance. So that will have given us a terminal loss. So with a terminal loss, will have meant that we would not be liable to any tax debt. So basically, that's how to find out if there's a recapture or a terminal loss. So in a nutshell, that's the chapter. This is what we cover in this chapter. We cover the statement of financial position, which shows the company's accounting value, on a particular date. And equally, we look at the statement of comprehensive income, which summarizes firm's performance over a period of time. I also look at cash flow, which is different between the dollar coming into the company and also dollar that goes out of the company. Again, the cash flow also measure after tax. And we look at also the capital cost allowance, which is depreciation for tax purpose in Canada. Again, do not forget the fact that in the first year of the asset being depreciated, half-year rule applies, and that's exactly what we have done. So that's the end of this chapter. The next chapter is looking at chapter 3, which looks at working capital and also working with financial statements.